Alright guys, it's Matthew Mickey in episode 3 of Buckets of Volatility, Liquidity, and the Fed. Oh my, we're going to talk about other measurements that I use to see the liquidity in the market, right? And where it's at, right? And now some of these that we talk about, I'll have further detailed classes on. Alright, and I'll tell you that, but I'll give you the broad sweep of things, right? So now the next way we can measure liquidity is through the NFCI, the Chicago Fed National Financial Condition Index, right? What it's showing us is the financial conditions within the U.S. on a basis of standard deviations, right? Anything below zero is loose condition and anything above zero is tight, right? It shows us the stress on the markets, right? It measures the financial conditions in money market, debt equities and shadow banking, aka non-banks, right? So you don't have an account with the Fed. If you have an account with the Fed, you're a commercial bank, right? And I do a whole video on this under how money's made, quantitative easing, and all that. So go to that playlist and check it out, right? Now I use the ANFCI because it's the adjusted index from the NFCI, right? It adjusts from different angles of the business cycle involving growth and inflation, right? And it works perfect with measuring what regiment or market condition we are in with the economy, right? Like, look at it. As we can see, since September, it has been going higher and higher and higher, right? And inflation's been going higher and higher and higher, right? This shows you liquidity is drying up and that volatility is going to pick up, right? It shows us the stress is increasing in financial assets. Now overlay that with the VIX. They move together. And the VIX is leading because it's live, while the ANFCI is a lagging report because it's reported weekly, right? This is why my setup and hedge plan is designed the way I have done it, right? The stress happens in risk-off environments, right? This allows us to see the stress coming. And then lastly, I'll talk about the dollar index, right? And so the dollar index I use it to measure risk on cycles, right? Because remember, it's not like any other currency. All other currencies are pegged off the dollar index. All commodities are pegged off the dollar index, etc., right? It's a basket of currencies, right? And if the dollar index is ripping higher, like it is currently, there is less demand for risk assets. There's other currencies, like their own people don't trust the currency, so they're fleeing to the US dollar, right? It's a safe haven, right? So when you see a rising dollar, it leads to stress in the market. It tends to lead the ANFCI as well. Why? Because if there's more cash on hand, there is less money to be lent, which is less money in the markets, right? Consumer confidence will start fading. And a lot of things will start fading that can be seen from the US dollar due to their confidence level. The monetary cycle is built on debt lending, right? So if lending slows down, there'll be more stress on our economy, right? And this ties in interest rates rising, right? Now look at the dollar weighted indexes to compare, emerging markets versus developed markets pouring their money into the dollar index. Allows you to see the valuation of the dollar index compared to, and the competitiveness to its partners like the euro and etc. And it also shows us, the international trade part of it as well, right? So that's definitely something that you have to, take into consideration, because it could be trade pouring into the dollar, or it could be something's the matter with that country's currency that they're safe haven into the US dollar, like we're seeing right now. Okay, so moving on. The biggest thing I want you to get is the dollar is a basket of other currencies, right? And the value is based on other currencies. So when the dollar goes up, it means the other countries are having some kind of economical issue. Like the euro is 57% of the dollar index. This is why I look at those $3 weighted indexes. Now gold, isn't a good medium to long-term investment right now, because bonds and gold hate rate hikes, and they are negatively correlated with real yields. Real yields love rate hikes. So I also look at gold and real yields and bonds, compared to the US dollar to see, if rising rates is fixing inflation, right? So if the market doesn't believe what the Fed is doing is going to fix the inflation, then you can look at gold and the ticker DBC, the ETF version of the stress index, or CRB, which is the Invesco Commodities Index. And if gold is bidding up, the market doesn't believe inflation is going to be fixed with the current monetary policy, right? Now, the Fed in 2022 started tightening in an already low liquidity environment, and people really need to pay attention to this, to the Fed balance sheet, to see if they're talking or actually doing what they're saying they're going to do. Now, before we wrap this class up, I want to talk to you about covariancy and correlations, right? And traders tend to think volatility as risk and forget that it also means opportunities, right? Volatility is in all asset classes and is a baseline to understanding where the money is going to go, right? If there's no volatility in prices, there's no chance to capitalize on your gains, right? Being smart with volatility in the right market conditions is what makes you successful versus everybody else, right? Volatility is measured with statistics called standard deviations, and the return is what we measure. Volatility can be up or down, right? That's why you have to pay attention to the market conditions, right? So you can calculate the average of a variance of a data series from a reference points, and if you break down the system, it'll be simple to you. It just takes a couple of times doing it, right? So standard deviation is the average of the whole data that you're using, and there's multiple ways to do this, and I'd go over this in multiple classes, right? It's known as realized volatilities, and we can find this using a distribution of returns, which I've done video on. I've done it on average true range percentage and implied volatility and how to do it, right? But what I want you to realize is correlation and volatility are heavily connected, right? Correlation is a statistical measure that indicates the extent to which two variables move with each other, right? The degree of how they are related, right? And correlation measures are usually done through the Pearson coefficient of correlation, right? The ranges are from 1 to -1. So a straight line, places the variable within the relationship in a linear fashion, and that's known as the pairwise, right? Two variables might have a positive change, and you might think that the relationship is positive or correlated. That's the wrong way to think of it, though. Every observation looks at it from a variable and is measured from the mean average, right? The average mean, right? And those numbers are then measured to see relationships between them. A 1 is a perfect relationship, where a -1 is complete opposites, like it's a negative correlation, right? Correlation of 0, they are perfectly uncorrelated, right? And there's no linear relationship. If it's an upward slope, it's a positive relationship. If it's a downward slope, it's a negative relationship. How they are dispersed on the slope shows the strength of the relationship, as you can see here in this chart. Look at 0, there's no relationship. Look at -1, there's a negative correlation. +1, there's a positive correlation, right? It shows they either move together or move against each other, or doesn't matter, right? Now, however, people always mess this up, thinking that if they over diversitize, it will help them, but over diversification can lead to lower returns when you continue to add low correlation ideas to your portfolio, right? Remember, correlation is not causation, though. This means just because there's a relationship between the two variables does not mean one moves and the other one will too, right? The cause needs to be the correlation factor, right? The reason Bitcoin is crashing with the rest of the market is because all asset classes are having liquidity taken away from the Fed because they're tightening their balance sheet. Now, do you see the causation is the same for both? Look at the 60-40 portfolio. This was popular to have because bonds have different driving factors than equities before 1998. Then the dot-com bubble happened, and they have had a negative correlation in today's market. They seem to be correlated the same as Bitcoin and equity markets are, right? And this is typical, right? Correlations change. Change is just a number and easy to misinterpret. So make sure you don't do that. Make sure there's causation behind using correlations, right? So you can't expect to look at descriptive statistics and place trades off of that, right? Anscombe quarter shows you that the variable can have the same average, variance, covariance, but different returns, right? The different returns is the volatility, right? The standard deviation, right? You have to understand the cause and the driving factor before using correlations as a conclusion, right? Alright, so if two variables are trending in the same direction, it can still go the other way. Alright, so now let's talk about the calculations using correlations. That's a whole nother class I'll do, but what I will tell you is, I talked about bonds and stocks. When liquidity dries up, the VIX pops up, and I ran the correlations when the VIX pops, the sector correlations, move more to 1 with the S&P 500, which makes it a double whammy on your portfolio volatility, because not only do the individual assets increase in volatility, but correlation magnifies this on your portfolio, which is why Ray Dalio was one of the best traders there was, because he knew how to incorporate enter and exit positions before volatility picked up in the overall market, right? So remember, when measuring the correlation of a variable, you need to do it from a weekly time frame. Then you take the weekly data and run the returns for the weekly close to close, and then you calculate current price to previous price minus 1, and then format it into a percentage, right? And that will let you see if what the causation and the correlation has to do within your assumption, right? And that's going to be needed as we go into the fixed income and we talk about real rates and bonds and the different market regiments. All right, guys, later.